In this video, we're going to cover trading stock options, and I want to show you a couple of trades real quick. Right here, you see two trades I made. One, I invested roughly $900, another one $1,100. Now, the profits on these two trades were $560 and $409. But look at the time frame. 3 days. This one was about 3 days, and this one was also 3 days. I opened and closed both of these trades on the same day. And so let me just show you this QQQ trade right here. I'm going to show you the chart on that trade. And so right here, I opened right here on this day, and I sold it here on a down day. I still made money. But just this short blip right here in the stock chart is how I was able to make this profit. And so this is roughly $1,000 profit in 3 days. And it's about 50% return on investment in respective to how much I invested. And one of the inherent problems with options trading is that for new traders, these type of returns just seem too good to be true. I mean, where else are you going to hear that you can make like $1,000 in 3 days or 50% return on your investment in a matter of days? It's not like they teach in school. And in any other form of stock market investing, you don't have these type of returns at such an accelerated rate in such a short period of time. And so new traders, a natural skepticism comes up, and that's natural. Okay. The problem is that these type of returns are normal. They can happen on a consistent basis if you develop the skills. And so what people do is they keep this kind of information out of their life when it can actually help them, especially people who don't have $30,000 to invest in stocks. And so what I want to do is give you a rundown of trading stock options and pretty much essentially show you that those type of returns you just saw, they can happen because of leverage. Option contracts have a magnified price movement compared to the stock they're attached to. Every option or stock option is attached to a particular stock. And so those stocks, the chart I just showed you, when that stock had a small move, well, that same equivalent move was magnified in the option's price. And so trading stock options is essentially the buying and selling of option contracts. And so just to give you some real world perspective of different investment styles, real estate investors, they buy and sell homes. Stock traders, they buy and share shares of stock. Well, we as option traders, we buy and sell contracts. Now, again, that might make no sense to you. You're like, what the heck? How do you make this kind of money trading contracts? I've never heard this before. So let me give you an example and bring it to a real world scenario. Let's say you find an undeveloped piece of land that you believe will increase in value over the next few years. And you go to the owner of this land and you say, hey, I want to secure the rights to buy this land for, let's say, about 25 grand. And so you drop a contract, it gives you about a 3-year time frame. So from this point on into 3 years in the future, you can buy this land at 25 grand. Now, we're in most real estate contracts, you have to put some money down. They usually call it earnest money. So let's say you paid $2,000 for the rights to this contract. Well, fast forward in time, 2 years later, the city has now built a new mall 15 miles down the road. New housing developments have gone up, and Walmart has built a super center right next to that lot you have the contract for. So remember, you have the right, but not the obligation to purchase that lot for 25 grand, and you only paid $2,000 for the rights for that contract. Well, that land is now worth 100 grand, and you're happy because you own a contract that says you get to buy a $100,000 piece of land for only $25,000. So let's stop here and slow down for a sec. So think on the surface level. Don't try to, a lot of people make the mistake of trying to comprehend option trading in one sitting. Not possible. Give up. Hey, think on the surface level here. You have a contract that allows you to buy something at a significant discount. All right. Think on that level. If you can get that, then you can understand options trading. Well, the buying side, that contract you have is more valuable because the underlying asset increased in value. And so those two trades I just showed you, well, my contract I bought became more valuable because the stock or that asset attached to that contract went up in value. And it only went up a little bit. And again, that's because of what they call leverage. Options are extremely leveraged vehicles, both in the positive direction and in the negative direction. So it's like investing on steroids. That's the way I like to think of it. Now, the trades you saw were call option trades. Now, there are two types of option contracts you can buy, calls or puts. And you buy calls to make money off of stocks that go up in price, and you buy puts to make money when stocks go down in price. So yes, despite what people said, you can actually make a ton of money when stocks fall in price. But I won't have time to cover all that in this short video. I'll have more training to cover all that. And so to make sure you get that training, what you can do is just subscribe to our YouTube channel or click on the link below. And what that does is keep you in the loop, and anytime we release new trainings, we'll let you know. All right, so you take care, and I'll talk to you soon.